Join Samantha and Hans at the next Macro to Micro Options Power Hour held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description.
What do you see, Hans?
We've seen an easing of fear levels, of course. We've been talking about this for a while, these very large ranges that we've seen that played into part of this almost existential worry that we had down around 5,000, 4,900, which was taken off the table. So we've taken off that sort of no one cares about us large premium to volatility, and it's coming quite a bit. We've seen skew really coming quite a bit lately, which is very interesting. So if you look at some measures if you look at COVID, for example, some of those skew measures stayed pretty bid for a good amount of time, maybe a year and a half into even after things started to rally back. So we've seen that relax very quickly. So almost kind of shades of what we've seen over the last few years, which is very big bounce backs. And August was a huge example of that. This time, not as much, but where people have been talking about how this can't be a V, it's going to be more of a W or some other letter that can pick maybe an S, or I don't know what it's going to look like. But we are getting a little bit of a V in some areas. So the VIX really coming down. But interestingly, over the last week, we haven't really seen a drop in fixed strike vol. So for folks out there who are like, what the heck does that mean? It just basically means when the market moves around, remember that the market can ride up skew, the market's implied vol skew, which is higher to the downside. So when the market goes down, it rides up those more expensive puts. So it's not really indicative necessarily of people scrambling and buying protection, just be moving down into an area of the options market that just happens to be priced higher. And so that makes the VIX go up, but it's not necessarily going up, just getting to that higher level of VIX. So that's what makes the little nuances. We talked a little bit about that last week with Brent, how there's sort of little nuances and little things that you can identify under the hood. When you see fixed strike, which means those strike actually have higher implied volatilities themselves than they did yesterday, that's when there's durable fear. What we've seen over the last week is that those fixed strikes haven't really come down very much. That's a sign that vol's found a happy level. So probably going into Mag 7 earnings, going in some of the data that we've got later on this week is the reason for that. But volatility's found a happy level. We're getting some big moves still, right? We're seeing some big moves, 1 to 2%. That's still a VIX 30 plus kind of environment. So 25, 24 is starting to get a little bit cheap for the time being. Now, we are also seeing realized volatility come in. So we are not seeing those sort of breakneck moves that we saw a little while ago, a few weeks ago. And that's playing into a sense of calm, and that's helping to bring the VIX down as well. So very interesting area. I've been talking about in the community this morning in the Slack. So I'm commenting and helping members out at Leduc. And I said, listen, I think it's going to be a buy the dip sort of environment. I think we've taken off that sort of very panicky reflex move potential to the downside with the Trump put, with the bond put, with the Trump put now, the number of flinches that we've seen. And so we're now in an area where I think the market is saying, okay, when can we start to look past some of the problems? And I'd love to hear your thoughts on, Samantha. I do it in your rooms and everything, but I'd like to hear it today, of course, on the show. The market can potentially, of course, so everyone's starting to talk about people are buying stuff, they're loading up inventories, they're stocking the pantries again, right? So they're buying lots of things. So the data is going to be a little bit skewed and not reflective of reality, potentially, the reality of tariffs and rising costs and things like that. And so they're saying, forget about that. Third quarter, we're going to start seeing some softness. We're going to see reality start to set in from an economic standpoint, from a data standpoint. But I think it's at that time that we're probably going to see a whole bunch of deals. There talks about India, talks about various deals brewing in the background, which adds to positive headline potential, which is also why the market is a little bit resilient here. There's this expectation of a little bit of a trickling in of good news over time. And so that's where we're at. Maybe we get to a point where the market starts to look at and say, look, 2025, forget about it. It's a throwaway. Let's look to 2026. Let's look to tax cuts or whatever, an extension of the existing tax plan. Let's look to regulatory benefits. Let's look to AI starting to create productivity advancements in businesses across all areas of the economy. Let's start to look to that. So I wonder how much is going to be considered if the market starting to say some of this is going to be transitory. I love that word, transitory. Jay Powell put that in the lexicon now, transitory. And when the market senses that something's transitory, you can bet that it's going to say not that important anymore.
For right now, I I think that this is still a bear market rally. And I know that many are excited about all these thrusts. There are three in particular kind of making their way through FinTwit. I'm not really into that particular approach, but it is something that technically gets bulls very excited. I think that all of those key breadth thrusts coincided with policy intervention. So my lens is always policy intervention. What do we have coming in for keeping the market bid? We had a very strong pullback, obviously 21.5% for SPY into that 48.78 SPX, very key level, right, which I had been projecting early and often. So this bounce that really formed on April 9th was policy intervention. It was Trump talking the bond market into calm, but most after a major rout in yield spikes on the 8th, right? But it was really policy intervention by Trump coming in and saying, hey, wait a minute, we're really just going to delay this for 90 days. So give it a breather. And obviously shorts had to cover. And then slowly it started to percolate higher because the market was basically pricing in a Trump fold. Some are bullish by nature, just always expecting the best, the peace deals, the trade deals, the tax cut deals. And while we're waiting, we're getting a lot of headlines, which is tons and tons of noise, but we don't have any actionable meat. Nonetheless, we're climbing that wall of worry while folks are very well hedged. So the pain, the max pain would be we get up and through that 57.50 and they start to cover those hedges. I think after they cover the hedges, it's going to be a slam dunk short because the structural problems, the functional and fundamental issues aren't going away, but it is an absolute grind higher. And so we really, right now, we're getting aftermarket Meta and Microsoft crushing it. Tesla did very poorly, but they got bid back up because of well-timed White House announcements, and they're still a cult stock. And Netflix beat. They're also quote unquote tariff proof along with Spotify. But the point is, we really still have an earnings sweet spot where the bar has been lowered consistently week after week for companies to be able to get over. And now we're going to be looking down the line at Q2, their guidance, their estimate. But right now we're also in the sweet spot as it relates to the dollar crashed. It didn't just fall 10%. It crashed and it has stopped crashing. Very helpful. Yields stopped rising. Very helpful. And basically we have daily, not weekly, daily intervention speak by Bessent and Lutnick and not Musk, he's done, and Trump. So I think this is part and parcel for the timing also of volatility. So I have to show you something because I think this kind of helps a little bit as far as framing why I had some of this bullish bent. But here is, for example, okay, so Monday morning, I updated this bullish bent continues for clients, and this is in my Slack Market Thoughts channel. Lots and lots of reasons, but in a nutshell, I still see this SPX 5633.27. It's a gap fill. We're going there. Now, of course, this morning we had a knee-jerk reaction lower that got bought. But the bigger thing is I still see VIX falling from last week. Once we got back inside a key level, I saw VVIX falling into 93 and VIX falling into 20. So let me just show you what that looks like. Okay, so this is basically a trend line where I came up with 20. It's not rocket science. It's also the 200-day. So once we actually came inside and broke the March high, this is very important. Remember the March high we talked about? We did the webinar right before options expiration and said, and I was like, it did a 2-bar reversal at 29.56. So anyway, I technically will analyze VIX, even though it's a reversion to the mean index and it's not a price per se like a stock. I don't care. It still works. Anyway, once we got above that, it was obviously hot fire flames in April and we got walloped right into that 60 mark. But the point is this has been fading. And once we got back inside 29.56, which was last Wednesday, this was really a tell that this whole realized volatility is going to soften right into expiration. And this is really coming right back down. We had a little bit of a shake right here, which is today, but you can notice on the intraday, since it's the 1 hour, that's the day, and that's the weekly, you can notice that this morning when we popped up here, I said, I don't trust it. It's too much too soon. And it wasn't about the GDP negative print per se, dissecting it to say it's not real. It was about this is too much too soon. I still see the next bout of volatility coming in once we come back down here to 20. So I think that was too much too soon. And literally, I literally said by 10 o'clock, you'll see puts monetize and this will come back in, break 29.60. You can see this 26.93 and come back in. And that will be very market bullish. And then what you've got right now is this, which is, again, looking at VIX and VVIX coming down and giving clients a way to navigate this. You can see what happened today. We were literally, I'm like, this is it. This is where it's going to come down. This is where it's going to stop and start moving higher. And this is the same thing with SPY. That's Qs, by the way. And the fact that we have not spiking yields, right, and not crashing dollar is also right now correlated to support for equities. Also, gold stopped going up last Wednesday, something we also talked about, and we were talking about it with Brent as well. Anyway, that coming down has also allowed equities to get a breather. So hopefully that is technically sharing, a little bit of how I looked at the bullish bent is still in play, even though we are absolutely susceptible to hard data coming in and interrupting the bullish flows. I still see a short-term bullish mode. Let's get through the mega cap 4 earnings this week, 2 more tomorrow. Let's see how non-farm payrolls it will deliver, but I'm not expecting any big surprises. And we could do this dance into sideways to higher until May expiration.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to 𝐬𝐿 Trading YouTube channel for more content.